Hello, everyone. Welcome and thank you for being here this afternoon. My name is Tracy BeGeorge. I'm the events coordinator here at Plan, and I am pleased to introduce Emily Wetter, our enterprise customer success manager here at Plan. What we're talking about here today is really important as we will be discussing Tax 101, Mastering the Basics, where participants will be equipped with knowledge needed to manage income effectively, make informed investment decisions, and remain compliant with tax laws. Before we dive in, yes, this webinar will be recorded, and please direct any questions into the Q&A, and we will do our best to answer them as we go. And with that, I'd love to hand it over to you, Emily, to discuss a few opportunities and begin your amazing presentation you have in store for us.
Yeah, thank you, Tracy. And hello, everyone. So while we are getting started here, and everyone's trying to contain their excitement about learning taxes today and going through the basics of tax, but also as we let others maybe join us live, just want to cover a couple housekeeping items before we hop in. So first and foremost, if you are joining us and you're not yet a user of Plan, you can go ahead and start a free trial with us. No obligation to commit. It's a 7-day free trial just to test out the program. I'm not necessarily going to be highlighting like in a demo fashion inside Plan today. I will show pictures that come from Plan, but that's not what the webinar is about. So if you want something, if you're intrigued just with tax planning overall, you want to incorporate it into your practice more, you can go ahead and start a free trial. You can also, during that trial, book a demo with a person on our sales team if you want maybe someone to go through the features with you. Also, we have a tax planning summit that is coming up on 4/2022. 4/22. Please, if you register and attend and you're a CFP, there's actually 3 CFP CE credits. So today's webinar is a CFP CE eligible for 1, but that tax planning summit would actually qualify you for 3 as well. So if you're a current user, you can register on your dashboard page. If you're not a current user, and current users and prospective users alike, Tracy should actually be posting some of this in the chat as well. So if you want to register for any of that, book a demo, start a free trial, you can do so there in the chat. Also, if you have any questions throughout the webinar today, pictured with me on screen right now, Michael Bauman and Aaron Graham. They are also on the team with me here at Plan. Michael works on the customer success team with me, and then Aaron works on the support team. Both of them have planning experience. We have a combined, I think between the 3 of us, about 30 plus years of planning experience here represented. So if you have a question, especially related to tax, I'm going to go through a tax calculation with you to start. If tax planning is new to you overall and you have a question, you have a group of folks here ready and willing to answer those questions. So if you do have one, the chat is closed down on your side, but the Q&A is open and available. So if you have your Zoom expanded, there's a little Q&A option, says Q&A and has a little talking symbol above it. Go ahead and click on that, post your questions there as we are going throughout the webinar. And then I still see it ticking up a little bit, but just for the sake of time, I am going to hop into things. We'll start with like an agenda, what we're going to go through today. And yes, thank you just for joining us and being willing to learn about taxes and go through Tax 101 and mastering the basics with us today. Give me just a second. I will share my screen. If I can get an audible yes or a thumbs up that you are seeing this, that would be perfect.
Yep.
Yes.
Perfect. All right. Okay. So, as mentioned, we will be going through the basics of tax today. And I see some folks who are raising hands here. We actually, we may need to turn off that feature. We won't, unfortunately, for the sake of time, be able to answer questions live like that. There should be a Q&A time near the end where we can grab some questions. But if you have any questions, once again, post them in the Q&A as time goes on. And I will answer this because it will come up. Is this being recorded? Absolutely. Will we be sending out that recording? Absolutely. And we'll also be sending out the slide deck to you. And if you did register today and you're a CFP for that credit, we will be submitting that on your behalf as long as you included your CFP ID when you registered. So, and you do need to stay the whole time if you are attending live and you're looking for that 1 hour of credit. All right. So, in today's webinar, when we talk about taxes and the basics of tax, why did we want to create a webinar like this for folks? Really, because taxes are so important, right? I think there's an element of tax that really touches and plays into our lives in a variety of ways, whether you're going to the store and buying something and sales tax is applicable, or if we're all taxpayers, right? We're all in our tax filing season right now. You're filing your own taxes, or when we talk about our presentation today and the importance of taxes, we're looking at it from maybe like a financial planning perspective, right? Tax planning really plays into different elements of that comprehensive planning picture in different ways. Within financial planning, we're looking at income management. We'll talk about capital gains today, long-term capital gains, qualified dividends, ordinary dividends, etc., how those play into the tax calculation. Retirement distributions. If we have income coming from different types of accounts, how are those taxed? It also plays into investment decisions, right? Maybe where our assets are being held, what are the tax liabilities associated with those? If something's sitting in an IRA as opposed to like a non-qualified account or a brokerage account, etc. And then, of course, estate planning, taxation concerning there. And really, when we're speaking to that, and when we talk about taxes from a planning perspective, and this leans into maximizing savings. We're talking about a lifetime tax savings concept with clients, right? So when I talk through the tax calculation, that's a year by year calculation. But really, when we think about it from a planning perspective and working with clients, we want to think about these things in as accumulating, right? So those tax liabilities, but year over year over year to make sure over the lifetime of our clients, they've paid the smallest amount of tax. So that might bring up, deduction, credit opportunities, those tax advantaged accounts. And we'll talk about those in more detail in just a moment. And then also, last but not least, everyone's favorite concept and term in the financial industry, we're going to talk about compliance. There's a compliance aspect that plays a role here, of course, in tax as well. We all know, sitting behind the scenes is the IRS. So we want to talk about, accurate filing overall, right? Making sure that we're filing our taxes appropriately and accordingly with the right forms and schedules for that taxpayer circumstance. We aren't necessarily the tax preparers. This isn't what this is about today, but there could be opportunity for you to set your clients up well for what they can expect that makes up their own tax picture. So we will talk about some of the tax forms and schedules that could apply for some of your situations that you're working with folks. And then also just some deadlines to be aware of when you are speaking with clients. Or all of these things really impact you guys too as taxpayers as well. So with that, we are going to actually start this webinar with the calculation of, this is going to walk through the calculation of federal income tax. We'll talk about other taxes and then credits. That's actually going to complete our total tax liability calculation overall. And I know that this looks like a lot all pictured on screen here right there, but we're going to digest this together. So um, right at the top there, and I'll try to use my cursor if you can see this, we're starting with total income. So we're going to digest each of these sections together where we get to that tax in purple at the bottom. So total income, what is total income? That's going to be everything in the basket, right? In our income basket. We're not yet dividing the income determined on, where did it come from, what type of account, etc. It's going to include wages, maybe IRA distributions, taxable Social Security. We're going to include, long-term capital gains income in here, qualified dividends. That's all included in total income, self-employment income, all in the basket to start. And then as we work through this, we're going to start to divide things appropriately. And when we start to work through the calculation, the next concept that we want to talk about are deductions. And when we talk about deductions, we have what are called above the line deductions and below the line deductions. Above the line deductions are actually those deductible items that will directly drive down your adjusted gross income because they are actually used, they're subtracted from your total income to and equates to your adjusted gross income or your AGI. AGI in this in tax land, when I say above the line is AGI. So if you hear that, if you've heard an accountant say that, they're talking about AGI. AGI is a really important concept that I want you to keep in your brain for right now, but also a few slides from now when we start talking about modified adjusted gross income or MAGI, because MAGI becomes important in determining maybe credit and deduction eligibility. So above the line deductions, examples of those common ones, if someone is able to deduct IRA contributions, HSA contributions, if they're making any sort of contributions outside of maybe what's taken from their wages on a pre-tax basis, they're making their own separate contributions, that they have deductibility opportunity there. And then when you're working with a self-employed taxpayer, a lot of times, of course, we'll have the deductible portion of self-employment tax. That's half of it. Half of what they owe for self-employment tax becomes deductible. It's an above the line deduction. And then if there's any sort of like self-employed health insurance premiums that they're paying, that's an above the line deduction. Also, if they're making any sort of contributions to like a SEP IRA, a solo 401k, some sort of work retirement account associated with the business that they own. Those are above the line deductions. And that equates to our AGI, as mentioned, AGI being the line. And then directly below that, we see our standard itemized deductions and qualified business income deduction, or QBI deduction. That is what I meant by below the line deductions. So, of course, standard and itemized deductions being the most popular and commonly known deduction, even I think with clients and planners alike, because folks are either taking the standard deduction or they're itemizing, right? So, traditionally, clients know that. Um, and then qualified business income deduction, that one, maybe not all clients know that just because if they're not self-employed, it wouldn't apply. So if someone does have their own business, they and a profitable business at that, they may qualify for this QBI income deduction opportunity, and that's actually below the a below the line deduction. It comes after AGI. So those below the line deductions equate to your taxable income. So now, once we have our taxable income, this is where we have the basket, right? Our basket of income. We started to take out our deductions appropriate of above the line, below the line. And now we're going to look at that basket of income and divide that income appropriately. So there's two different flavors of income we're looking for here. We have ordinary income versus our qualified income. Ordinary income, pictured on the left-hand side of this slide, is going to include things like your wages, taxable interest, ordinary dividends, short-term capital gains, taxable IRA distributions, taxable Social Security, business income, excuse me, anyone who maybe has Schedule E type income. Real popular one in that respect would be like rental income. Sometimes you see royalties pop up there, and then partnership income or S Corp if someone's an S Corp owner and they have that flow through activity to their Schedule E. That's all on the ordinary income side. Our ordinary income, that's taxed at that traditional marginal bracket system that we know of, right? The 10, 12, 22, and so on, tax nature. And then on the other side, though, we're still looking at a marginal bracket, but this is on our qualified income. Qualified income includes our qualified dividends and long-term capital gains. And we're going to digest this in even a little bit more detail, especially when we talk about the taxation on qualified dividends and long-term capital gains. But bear with me here. Just take note, qualified income still has its own marginal bracket system, but that's taxed a little more optimally at that 0, 15, and or 20% tax nature. And then, as you can see, this then comes together and equates to our taxes. This isn't yet our full tax liability, so keep that in mind. Right now, that purple taxes there at the bottom, that means we've calculated the federal income tax for the taxpayer at this point. We would still want to be mindful of any sort of other taxes that would apply to the situation and or our credit opportunities. But before we move on to those, I said I was going to digest the marginal brackets, the ordinary income versus qualified income. So when we are thinking of, and we'll start with ordinary income, um, we want to think of, a lot of times I think there's a misconception, especially on our side when we're looking maybe through support tickets, et cetera, that are coming through in Holistiplan. And in fact, this picture, this example is coming directly off of a tax report from Holistiplan. So in this example, we have someone who has taxable income of $179,000, pictured up here, upper left-hand side in black. The misconception happens with, well, this 179,000, they apply it to the marginal bracket under ordinary income, and then they're thinking, or maybe the client is thinking, all of that taxable income is taxed at 22% because that's the income threshold it falls within, right? That 89 to $190,000 mark. Not the case, right? Because taxable income, although used in the qualified income taxable space, we'll get to that in the next slide, we actually need to subtract a dollar amount out of that 179,000 to equate to our ordinary income. So that's pictured up here. So in purple, our qualified income would actually need to reduce that taxable income. So the $179,000 less the qualified income amount of 36,500. So we're taking out our qualified dividends, our long-term capital gains totaling 36,500, because remember, those are going to be taxed a little differently than ordinary income. That actually leaves us with this amount here in this brown, orange color here of just over $142,000. Now that's still taxed in that 22% marginal bracket space, less than the 179,000 amount that I mentioned for taxable income. However, also important to go through how that was taxed progressively, right? So outlined here, that was actually taxed at a 10, 12, and then those last dollars above the threshold of 89,000 was taxed at 22%. So this at the bottom where it says this is the marginal rate at which the next dollar of ordinary income will be taxed. So when you are working with a client, a lot of times they will confuse, maybe we've talked through what their ordinary income is, but then they think it was all taxed at 22%. So really important to identify that no, some of those dollars and a lot of those dollars were taxed progressively up to that point in time. And even if we earned more than this 142 and our tax liability was higher, it still would be taxed at that progressive tax nature. And I did once again see a couple people raising their hand. Yep. So if you have any questions, just for the sake of time, we can't necessarily answer them live right now. At the end, there may be time for Q&A, but if you do have any questions, feel free to post those in the Q&A. My colleagues, Michael and Aaron, will be answering all of those as I go throughout the material here today. So, but thank you for having questions. So that's important. I love that interactivity. So when we think about marginal brackets still, qualified income, on the qualified income side now. So we talked about ordinary income. We talked about how we had to back out the qualified income from the taxable income to equate to the ordinary income. On the qualified income side, when we're talking about the taxation on long-term capital gains and qualified dividends, that $36,500 amount, this dollar amount here now in orange pictured up top, we do actually want to be mindful of what our taxable income amount is. So that $179,000 amount. Why do we want to be mindful of that? That is because our taxable income here on the left-hand side of this picture, you'll see that same $179,000 amount, and it's outlined here in orange in the 15% marginal rate. That's actually determining the threshold at which the qualified income is going to get taxed. So when we talk about qualified income, we do want to be mindful of what that taxable income dollar amount is, because it is determining the rate, the marginal rate at which qualified income will be taxed. So another way to think about this, if this graph on the left-hand side or this chart isn't exactly landing well, I think the right-hand side will do a good job of identifying how this works. So taxable income, once again, made up of two different flavors of income, right? ordinary plus our qualified, and they're actually stacked. So when we stack them in tax, on the bottom sits the ordinary income. So that's outlined here in teal, ordinary income. That's sitting on the bottom. And then on top in orange is actually our qualified income. So that's how it always works. Your ordinary income will be on the bottom, your qualified income will be on the top. And in this instance, this threshold here of just over $89,000, our ordinary income in teal, do you see how it goes above that threshold? That means that all the qualified income sits above the threshold at which it went from 0% to 15% tax nature on the qualified income. So that's why it's getting taxed at 15%. Something that's not pictured here, but is really important to know, and I call this out because I think the rule, possibly like many rules in the Internal Revenue Code, written in a bit of a confusing fashion, but you can actually be working with a circumstance where this qualified income could be straddling this income threshold line. So what do I mean by that? In not It's not pictured, but imagine this with me. If this teal coloring was actually like down here by the $50,000 mark, and then up top was the orange above that, you might actually have a portion of the qualified income taxed at zero, and then whatever portion landed above the dotted line, that portion would be taxed at 15%. So you can be working with a situation where qualified income could be getting taxed at two different marginal rates. So I think the rule is written where it sounds like it's either or, but in reality, it could be straddling a line where it's taxed at 0 and then 15. Or if you're working with someone with a lot of income, it could be straddling that 15, 20% line. All right. So I mentioned before, our tax liability calculation was not yet done. And so we'll continue on with that. So we do want to consider what are some other taxes. So taxes, we have our federal income taxes, which we went through the calculation, and then these other taxes. I'm going to lump together talking about the alternative minimum tax, the additional Medicare tax, and the net investment income tax, or the NIT. Just because those, I'm lumping them together because a lot of times who they apply to are our high income taxpayers or earners. So because if someone's triggering those, it traditionally means they have quite a bit of income to be doing so. So what is alternative minimum tax? If we just need a reminder of what the AMT is, that's actually that parallel tax system that's running in parallel to the standard tax calculation. So it applies to every single taxpayer. A lot of our maybe clients, taxpayers don't trigger it, but for the ones that do, they're triggering it because as those two calculations are running in parallel, it will actually take whatever the higher tax liability is between the AMT and the standard tax calculation. Like I said, a lot of folks theirs is the standard tax calculation, so they might not even realize the AMT exists, but it is sitting there. And if we maybe go way back to another tax planning course or that CFP course that you took right on the test here, I don't want to trigger any PTSD, but this, when you think about AMT, if someone is triggering the AMT tax, it's just notable that it will disallow for certain deduction or exemption opportunities that may be applied to the standard tax calculation. But if they triggered AMT, they may not get those. We also might be dealing with AMT preference items, right? And then, excuse me, when we think about the additional Medicare tax, once again, a surtax that typically applies to your high income earners. This is to fund Medicare. It was introduced under the Affordable Care Act or the ACA. And that is actually that taxation of an additional 0.9% on income once someone exceeds a certain threshold based on their filing status. Along those same or similar lines is the net investment income tax or the NIT tax, and that would apply to, once again, a higher income individual. And that is also introduced through the Affordable Care Act or the ACA. But that's that additional 3.8% that actually applies itself. And this is where it might get a little confusing. There's a lesser of terminology. We're not going to dive deep into the nit tax, so don't worry. But there is a lesser of where it's an additional 3.8% on the lesser of net investment income or total income, once again, above a certain threshold once someone exceeds a certain MAGI dollar amount. So that's where I said MAGI again, right? That's why we want to talk about that in a couple slides from now, and why it's so important to consider someone's MAGI calculation. But once again, those are determined based on filing status for the individual or couple. And then, of course, last but not least, self-employment tax. So, if you're working with someone who's self-employed and they have a profitable business, we are looking at they'll be subject to self-employment tax. A lot of folks here on the call might be subject to self-employment tax, right? If you own your own firm, this is that taxation that covers Social Security and Medicare at a total rate of 15.3%, divided 12.4% for Social Security, 2.9% for Medicare. And then, outside of other taxes that might get triggered for a taxpayer or a couple, we also have credit opportunities, right? So, credits can actually directly drive down the tax liability dollar for dollar. When we think about credits, once again, you might pick up on a theme. There's another two different flavors. We're looking at non-refundable and refundable credits. So as a reminder, non-refundable, and we have a few of some of the more commonly known um, non-refundable credits listed here. Those can reduce a tax bill to zero, but they can't reduce it past zero. Whereas on the other side, we have refundable credits. Refundable credits are fun credits. So if you want to think about it like that, not that non-refundable aren't fun also, but refundable, they have this, you can actually reduce the tax bill below zero. So this is that instance where you could actually take your tax bill to zero and then get a check back from the government. That's really exciting, right? So to apply an example to this concept, if you have someone who has a $5,000 tax liability and they qualified for $6,000 of non-refundable credits, you could take 5,000 of the 6,000 that they qualified for and reduce the tax liability to zero. Whereas if they were $6,000 of refundable credits, you could reduce that 5,000 tax liability to zero, and then the taxpayer would actually get $1,000 back as a check from the government. So exciting. All right. So now, when we think about, we've gone through the tax calculation, we've gone through some of that terminology that we want to be mindful of. Now we want to talk about, and this is once again, we're not being tax preparers, but we're being mindful of what goes into tax preparation to make sure our clients are set up for success. And that's talking about filing requirements. So when we think about filing requirements overall, sometimes there's just that filing requirement, just do I have to file my taxes, right? So that can depend on a variety of factors, gross income, what's their filing threshold amount based on their filing status, are they self-employed and have to file for that Schedule C situation? Are they maybe a dependent? Do they qualify for certain refundable credits? So we just talked about credits, right? If you are working with someone who qualifies for refundable credits, they might be in a situation where they have really low income and they actually maybe wouldn't necessarily have to file their taxes based on that low income situation, but in their situation, they actually qualify for some of those refundable credits. So even if their tax bill is zero or even negative, they want to file a tax return to prove that, hey, I do get some of this money back because I qualified for this particular credit. So that's why it can become important. Every taxpayer situation is different. The IRS actually offers an interactive tax assistant. If I, hopefully you can see this. Like I said, we'll share the slide deck, so you'll get a link to this, so you don't have to like write it down or memorize it. But the IRS actually we'll call it kindly, provides a tool where you can actually walk through as a taxpayer and determine if you would need to file a tax return. Um, in addition to when we think about filing, it's important to think about the forms and schedules that would be included in that filing, right? So the tax preparer is going to ultimately be responsible for the data entry regarding these, the schedules, the forms, etc., that are applicable to the client's situation. But these can be important forms to just make our clients aware of, hey, just remember, you might have these different 1099 forms that you want to be sure that you're bringing to your tax preparer so they know these different income items happened for you this year, etc. I don't think I need to go through what a Form 1040 or Form W-2 is for folks here. But on the other side of this, when we talk about our schedules, 1, 2, and 3, A, B, C, D, here, just as a reminder that Schedule 1, 2, and 3, apologize, I am just getting over a cold, so bear with me. But these are schedules that are used to report things like your additional income, maybe adjustments to income, if we have any sort of additional taxes, like what we had just talked about, or maybe some additional credits and payments. Those are going to be recorded on Schedules 1, 2, and 3, and then that support the federal Form 1040. And then our schedules A, B, C, D here, E and SE listed here. Just real quickly, as a reminder, A is for itemizing. B is going to be for reporting any sort of like taxable interest and ordinary dividends. Your C will be for any sort of capital gains, or sorry, Schedule C is for your self-employed individuals for their companies, reporting their profit or loss from the business. D is your capital gains or capital losses. And then E is going to be that pass-through type income, maybe from an S corp situation, rentals, royalties, partnerships, etc. And then SC standing for self-employed. So that's going to go through that self-employment tax. Additional forms, there were a couple others that I didn't call out the form number here, but just to be mindful of because they show up more often than others might, is Form 8960. That's for the NIT tax, the net investment income tax, and then also Form 8606. If you've ever done a backdoor Roth IRA contribution with a client, you are familiar with Form 8606, or reminding the client of Form 8606 because that's for your non-deductible IRA contributions. And then, of course, our tax filing and withholding deadlines. So when you're looking at this, I think you're going to gather, remember the date, just 15, and then everything else to remember would just be the respective month. So I think April 15th, I don't have to remind anyone on this call that 6 days from now is the tax filing deadline without an extension. With an extension, October 15th. I think one of the more important elements to remember there is that that's the tax filing deadline. Um, so that's the tax filing, and then you get an extension for filing. It's not an extension for paying, though. So your payment or your estimated payment that for your tax liability for the year for 2024 still due April 15th. So you might have until October 15th to file all your appropriate forms and schedules, etc. But 15th is for paying, or April 15th is for paying. And then when we do think about payments, and as we are looking at a current tax year, we should talk about quarterly payments. Now, sometimes folks think, well, that doesn't apply to me because that maybe only applies to like a self-employed individual. Quarterly payments do actually apply to everyone. A lot of people actually just aren't aware of those dates because their quarterly payments, their estimated payments, those are being paid through withholdings from their wages, right? So they're a W-2, maybe salary paid employee somewhere. So those are actually getting paid in those quarterly installments on their behalf, but they're through wages. So they might go unnoticed by the taxpayer. But a self-employed individual is usually very aware of these dates because this is when they are paying those taxes, for their self-employed situation, for their business. So those dates are happen on the 15th of these months, April, June, September, and January of the following year. And then we'll talk about quarterly payments in a few slides from now as well. And before we transition into, I kept foreshadowing MAGI or modified adjusted gross income, why that's important. We want to think about our AGI. I think it's important to just recap deductions and credits because this is what MAGI largely contributes to. If someone's qualifying for certain deductions and credits, MAGI is used in other ways as well, but in ours, we're going to largely focus on deductions and credits today. So, just as a reminder, what is a deduction? A deduction is something that can reduce your taxable income. So, that's the amount of income that would be subject to tax. And then those are two different flavors, above the line, below the line being AGI. Deductions that are above the line reduce our AGI dollar amount, below the line are subtracted from AGI and drive down taxable income. On the other side, we have credits, right? So credits are what we talked about that come near the end of that tax calculation, and those are things that can actually drive down our tax liability dollar for dollar. Once again, two different flavors. We have non-refundable and refundable. Non-refundable credits, those are going to be able to reduce a tax liability to zero. Refundable can reduce them to zero and below or beyond. And then how do you qualify for them? This is where we start to talk about MAGI. So it's going to depend on the taxpayer circumstance, like a filing status. Filing status will determine where maybe certain MAGI thresholds start and end, et cetera. And then also the calculation itself for modified adjusted gross income. So when we talk about that, this is actually, if you've never used Holistic Plan before, this is pulled directly from a Holistic Plan tax report. It's not a live version, so I can't actually click into any of these question marks here. If I were actually in a Holistic Plan tax report, I could. It would give me some more information around, how certain credits, deductions might be calculated and what they mean. But we're just thinking about it very high level today in this course, the basics, right? So when I talk about MAGI, that's the modification of adjusted gross income. This is where I said, remember AGI, put it in your brain bank for a few slides later. This is where we want to remember it. So, and this is why those above the line deductions are so important because they directly drive down AGI. Your AGI is used to calculate your different credit and deduction opportunities. It might even be used to calculate if you trigger a certain tax, like in this case, the net investment income tax. That uses its own MAGI calculation. So when we look at these though, you'll notice different definitions here, MAGI definition 1, 2, 3, etc. That is because the gift of the Magi is gifted in different ways. So we're modifying that adjusted gross income in a different fashion. So when I talk about that, they all really begin with AGI or adjusted gross income. And then from there, we're adding back certain income items traditionally. So once again, if I were in a live version in Holistiplan, I could click on the question mark, it would pop up and show you that MAGI calculation for each one. So here you'll just need to trust me, but that's how we're defining them. So it's based on how these credits and deduction opportunities are all defined by this definition of the MAGI calculation, whereas net investment income tax stands alone and has its own MAGI calculation, and then so on and so forth. And then here inside of Holistiplan, we will actually determine if someone's over, under, or it would say in phase out and be in yellow if they were within, a threshold here, an income threshold. So this can of course present itself with planning opportunities, right? And we'll talk about planning opportunities, or if you haven't already gathered, that's really the concept of this whole thing, right? We're talking about tax planning overall. We want to think about the lifetime tax savings of a client. We want to think about what maybe year by year are they qualifying for from a credit or deduction opportunity. Really important to note though as well that built within these credit and deduction opportunities may be additional triggers for qualifying. And what do I mean by that? We'll take the child tax credit, for example, for this situation. This taxpayer qualifies for it from a mathematical standpoint. They're under that child tax credit threshold. However, let's make an assumption that they don't actually have any dependents or they don't actually have any children from a tax standpoint. So even though they're under in the credit from a math standpoint, they don't actually have a child to qualify for the credit. So just be mindful of that, that even if someone's under mathematically speaking for a credit opportunity, there might be additional triggers that need to be satisfied in order for them to actually take advantage of that credit. All right. Now we're going to kind of transition here or think about from a planning aspect, just kind of tax advantaged accounts overall. And actually listed on the right hand side, you might see one of those words here or accounts, and you're going to say, that's not a tax advantaged account. Well, we're going to talk about that and how tax savings are actually built. Tax saving opportunities, I should say, are actually built within that space of being a non-qualified account. But to start, qualified accounts, what is a qualified account? These are your accounts that I'm sure everyone here on the call knows, and I don't necessarily have to remind you of, but those are going to include things like 401ks, 403bs, 457 plans, work retirement accounts, your IRAs, right? A traditional IRA, a Roth IRA, a SEP IRA, etc. These are all of our qualified accounts. These are accounts that offer tax advantage opportunities, and they're all because there are rules that are written within the Internal Revenue Code that allow for it. So they're typically sponsored by your employer, or they're established on more of an individual basis, especially when we talk about an IRA, individual retirement account. And they're all going to have specific rules regarding contributions, withdrawals, tax treatment, maybe eligibility, etc. And along the same similar lines, but slightly different, we have health and medical savings accounts. Those are going to be health and medically related. But a really common one there would, of course, be an HSA or a health savings account. But you might also see things like flexible spending accounts, FSAs, health reimbursement arrangements, HRAs, not as common anymore, but still show up here and there. When we talk about an HSA, right, that's that, if you've ever heard the triple tax savings concept, right, we're working with someone who they have contributions are on a pre-tax basis or tax deductible. So pre-tax meaning if they contribute directly from wages through the employer, tax deductible if they're making outside contributions to the health savings account. The funds grow tax free, and then you can actually withdraw tax free as long as it's for qualified medical um, expenses later in life. And then we have our non-qualified accounts. So I mentioned that that's not necessarily a tax advantaged account, but why did I want to bring that up here in a tax advantaged account slide? Because there's baked in within that tax savings opportunities. And that's where we're actually going to remember our qualified income. This is really confusing because qualified income actually derives from non-qualified accounts. So like a brokerage account where we're talking about qualified dividends and long-term capital gains, that's actually our qualified income, but it's coming from a non-qualified account. Whereas I don't want you to confuse that qualified income when we think of the tax calculation as coming from a qualified account, because actually income coming from a qualified account like an IRA will actually be taxed as ordinary income. So I know that's super confusing, and maybe that's just job security for the IRS in using similar terminology like that. But just remember, non-qualified accounts in the tax calculation will apply to your qualified income opportunities. So that's where you have your long-term capital gains, qualified dividends, taxed more optimally at that 0, 15, and 20% tax nature. So that's why we wanted to bring it up here. There's also a nuance. This may feel thrown in, but it's on purpose. So let's talk through it. Social Security taxation. This is just a tax calculation nuance that we have seen time and time again here on the Holista plan side. Even in practice, when I was doing tax calculations quite manually before we were using Holista plan and as a practicing advisor, and it's a calculation that can go awry quite quickly if you're unfamiliar with how it's calculated. So that's why we want to call it out and talk through it. So, how is Social Security taxed? How do we determine the taxation of Social Security? I think there's some misconceptions around this where it's all of it is taxed, at 85% or none of it, etc. So, let's talk through it. When we first calculate Social Security taxation, we have to think about and calculate what's called combined income. So, combined income or provisional income, you might have heard that as well. That's taking half of the Social Security benefits and then you're adding back in these different income items. So, tax exempt interest, wages, etc. And then we need to apply that combined income, that calculated dollar amount to Social Security income brackets. So, Social Security has its own income brackets. If things weren't already confusing, now you have a combined income associated with Social Security that has its own income bracket nature. And it's dependent on how what their filing status is. Single filers have different thresholds than married filing jointly. And if you're married filing separately, you will likely just pay taxes on your benefits. So there's a couple situations where that might not apply necessarily, but you're likely paying taxes on them. However, when we think about a single filer or married filing jointly, this is where we want to be mindful of different thresholds. Up to a threshold is 0%. Within a threshold band is up to 50% of the benefits. And then past the threshold is up to 85% of the benefits becoming taxable. That up to terminology is very important. That's where the misconception of it was all taxed, that 85% of it is always taxed. That's where there can be that misconception. So we're going to actually break this down. We're going to use the Smiths. They are a married filing jointly couple, and their combined income calculation, we want to think of this $56,500 combined income value. As we apply that to the married filing jointly bracket breakdown, anything that is below $32,000 is taxed at 0. And then anything that lands within the 32,000 to 44,000 is taxed at 50%. So in this case, we're working with a combined income that exceeds this threshold, so 56,500. So this bandwidth here of 12,000 is taxed at 50%. So that's $6,000. And we're actually going to break it down here, but I'll get to that in just a second. And then anything above the 44,000, that would be taxed at up to 85%. So in this case, the difference here of 12,500 is taxed at 85%. So how do we break that down? Up to 32,000 taxed at 0, plus that portion that's taxed within here, this bandwidth, that's the 12,000 times 0.5. Here's your 6,000, plus anything that basically what was left over up to 56,500 past 44,000, that left us with a difference of 12,500 taxed at 85% to equate to $10,625. So we would add these three together, and that equates to $16,625 of their Social Security would actually become taxable, or that's the taxation. So this is where it's really important to understand that up to terminology, right? All right, so this is starting to kind of wind down in the presentation. We've gone through the tax calculation, we've gone through some other taxes, credits, deduction opportunities, your MAGI calculation, taxation nuance on Social Security. Now we're thinking about how do we prepare our clients to really be ready to communicate some of these different elements or items with their tax preparer. So this is where we're really bringing tax planning full circle with our clients. And that's where we want to create some sort of client communication piece. Pictured on the right here is a tax letter out of the Holistic Plan software. You can certainly create your own tax letter or email, something like that. The point of it, though, is to communicate or identify important tax documents that apply to the client or that taxpayer from throughout the year that you would know about and be aware about, to communicate that on to the preparer or the accountant, right? We want to involve the tax preparer as much as possible when we have that mutually shared client, just because we want to make sure, when we think about the client, we're all working on the same team, right? And we want to make sure that each person is aware of the plays that are going on, and how they might specifically impact whatever job they're assigned when working with this client. So an example here, just because we have time, I'll give this. Something that can be miscommunicated and then lead things to get identified, perhaps, once taxes get filed, etc., could be someone has an RMD obligation, required minimum distribution, and they also are eligible and they choose to make a qualified charitable distribution or a QCD, and the QCD doesn't get reported onto the tax preparer. So all the tax preparer sees is the 1099-R form. And the 1099-R says there was $50,000 that came out of this IRA. And to them, the client forgot to tell him that, oh, I made a QCD of $10,000 to church for my IRA. So they just know that 50,000 came out of the IRA. They list it all as taxable, go along on their merrily way. But come to find out, they forgot to actually report that 10,000 of that 50,000 was tax-free because it was a QCD, etc. Now you have some missed expectations happening between the tax preparer, the client, yourself, etc. So really important to communicate these different items that are happening for the client. So everyone's on the same page. And that's whether you're using Holistic Plan or not, I would suggest making some sort of communication piece. And then also, this is where I mentioned we'd talk again about estimated tax payments, and who typically pays quarterly. We talked through that everyone pays quarterly, but the folks who actually are filling out there's a proper form that you fill out with each of those quarterly payments. Those are traditionally your self-employed folks. They're very aware of when they have to pay quarterly. Or sometimes, another instance where at least I ran into it, where I would say was maybe second most often, was I was working with a retiree who they were taking income from different sources and maybe not taking taxation directly from like that income source at the time that the distribution was made. So later we would make quarterly payments based on when that income was getting distributed to them. So they wanted to be mindful of the quarterly payments throughout the year as well. And then safe harbor. Safe harbor is there's there's a lot within safe harbor. We're not going to get into the details of it necessarily, but just be mindful that safe harbor really is, it's kind of the safety net around, if a client is paying, their estimated tax. They have a certain amount, as long as they're within a certain dollar amount, or they've paid at least a certain dollar amount, they won't trigger what would be a penalty for not paying enough. So that's what safe harbor, and kind of the most we'll get into on safe harbor in this presentation would mean. And then, of course, to kind of end our time here, planning strategies. When we think about tax planning, of course, we are thinking of that lifetime tax savings strategy for client, and that strategy overall probably has multiple strategies baked within it. So we might be talking about Roth conversions, charitable gifting, gains loss harvesting, savings to retirement accounts, etc. And so on the right-hand side here is pictured a tax report out of Plan. There's actually, once again, if you haven't used Plan before, there's an observation section included with all your tax reports that would highlight some planning strategies. for you. So it's through the power of our optical character recognition software that reads in tax returns. But once again, I'm not diving into Holistiplan, just making note why that's pictured there on the right. So with that, hopefully you can take away, you've maybe learned something from the tax calculation. Maybe you knew some elements of it, but you learned some new things today, hopefully. Or it reminded you of some things that maybe you forgot about. Um, talking through different filing requirements, right? Different forms, different filing deadlines, tax nuances, especially as it relates to maybe additional taxes that are getting triggered for some folks, or that Social Security taxation element, etc. You've maybe thought of some ideas to help your clients get organized. Maybe it's a little too late in the season for this year, but it could be maybe you've thought of some ideas for next year when you are working with your clients, and then future opportunities, of course. So tax planning. Here at Holistiplan, we say tax planning is a year-round sport. So there are future opportunities all year round. Um, Once again, if you, I mentioned this at the beginning, if you joined me in the middle and didn't hear it, if you aren't yet a Holistiplan user, you can certainly start a free trial with us, book a demo, or if you're a current or prospective user, you can also sign up for our tax planning summit that's coming up on April 22nd. We would love to have you there. Today's course, as long as you stay the whole time or stayed the whole time here with me, and thank you. I know I talk a lot, so thank you for listening to me. Um, you earned at least one CFP CE credit, but if you join us for the Tax Planning Summit, you have opportunity to earn up to 3 CFP CE credits at that event. And then if you do have any questions, feel free to reach out to our team here, info@holistiplan.com. If you're a current user and I was talking about Holistiplan, or some of this maybe triggered some ideas of how you just want some ideas on how to use Holistiplan more, please feel free to reach out to the success team. It's just success@holistiplan.com. We'd be happy to put some appropriate resources in your hands. Also, our support team. So if you are working on a client case inside of Holistiplan, you'll see a contact support button at the upper right-hand side. If you have any sort of case-specific questions, just click on that. Our support team is super duper quick to respond and very helpful. As mentioned, we have a lot of planners on our team, and we would be happy to walk you through, a case with you. All right, I'm done talking. Are there any questions that are left to answer live? I think they got all answered.
Alrighty, we are close to time. Thank you, Emily. That was amazing. And just to recap, we will be sending out the slides and recording, so ensure to keep an eye out for that. Also, as Emily mentioned prior, all the links for the free trial to explore our platform, booking a demo, if you prefer to connect with someone from our team, we will provide a walkthrough of the platform. And if you have not yet, but would love to register and join us for the 2025 Tax Planning Summit on April 22nd, is all within the chat. So all the links are there for you to utilize. And thank you everybody for joining and attending. And with that, we'll see you next time.
Yeah, thank you, everyone.
Thank you so much. Bye.